The script is about to flip for Canadian real estate investors, and although right now it is pretty quiet, there are some monumental changes that are coming down the pipeline in 2026 directly from OSFI as the risk to the housing market continues to weigh in. And a lot of this may not apply to most common mortgage holders, especially those first-time home buyers. But I think if you peel back the onion here, there's a lot of changes that OSFI is going to be looking to implement and how that's going to change the banking models moving forward this week. I want to take an opportunity, unpack that, all that and more this week. Once again, thanks for stopping by. If you have not subscribed to the channel, please consider subscribing, hit that notification bell while you're down there. Don't forget to like and share the video, leave your thoughts and questions, concerns in the comments section below. I want to hear from you, and we'll get right into it. So ultimately by now, you may or may not have heard about OSFI's changes coming in 2026 for real estate investors, especially Canadian real estate investors. More importantly, the mom and pop. It's more applicable to the smaller investors, not necessarily the major corporations that work on a different income structure. So in a nutshell, you're not allowed to double dip anymore when it comes to using rental income to qualify for the next rental. For example, you own your existing home, you have a rental property, now you'll be able to use that rent and your income to qualify for potentially the third property. Now, basically each mortgage stands alone. And now ultimately there are a lot of nuances within this. Ultimately, what you're showing, what you're declaring, what the rent is. And in a market right now with declining rents, are you as an individual claiming that rent on your income? If you are a landlord, a lot of things to really consider. It's basically pushing for Canadians who want to purchase investment properties to show more income or have a higher income. And those properties need to service, so that could require more down payment on the potential investor. So all of this to say that for many Canadians, it's going to get a lot more challenging to purchase an investment property. Now, all of this comes at a time when the GTA is facing a massive condo crisis. I mean, we're always talking about how Canada is in a housing shortage and so many other nuances here, and ultimately way too many to discuss in a brief video. But if you think about it for a moment, what OSFI is doing, in my opinion, is trying to make the financial system a little bit more resilient. If you take a step back and think about how things were done in the past and how things are going to be done in the future, and once again, quick caveat, a lot of the banks haven't really adapted to these changes yet. That's coming in the new year. A lot of them may offer different solutions to the same problem. They may potentially follow OSFI's guidelines and they are allowed to increase their thresholds, right? They can make it even more difficult than what OSFI wants. Some lenders might just do the bare minimum. I mean, ultimately, all this will be discovered in due time. Make sure you subscribe to the channel so when we do talk about those changes, you will get notified. But here's the reality. I think for a lot of Canadians that are watching this channel, maybe they're not a real estate investor. They're like, this has nothing to do with me. Well, it does to some degree, because what OSFI is doing is literally laying out the groundwork for potential future changes. Case in point is that the combined loan products, or CLPs, combined loan products, are going to be changing in 2027, or at least that's what they have set right now. Now, once again, this is just a conversation, but conversations are like a seed. If you plant the seed and you water it, it continues to grow. And this could be one of many changes that could be coming down the pipeline. So what is the changes to the combined loan product? What is a combined loan product? Well, for most Canadians that have a mortgage with a line of credit that's built into one product, that potentially means that, you might have a line of credit, a home equity line of credit, and a mortgage. In the past, if you, let's say, missed a mortgage payment, but you were up to date with your line of credit, well, it wouldn't trigger necessarily a default or a arrears. It means that the whole entire program, the entire loan product goes into default. Whereas opposed to the previous way, it was just that particular one. It wouldn't necessarily trigger further action on the bank's end. Now, that's all going to be changing. And if you couple the real estate investors changes that are coming 2026, the CLP changes that are coming in 2027, the conversation about qualification of income coming down the pipeline, how the banks are going to look at income, what reserves, what capital they're going to have for mortgages that don't fit the mold. Those are the ones that are a little bit extended, especially if you're putting 20% or more down. If you're not putting 20% or more down, if you're putting 20% or less down, I should say, there's really no adjustment to those ratios. They are very strict. But if you're putting 20% or more and under certain guidelines, the banks may approve you for the mortgage at a slightly higher servicing ratio. So all these things are sort of, in my mind, playing to, hey, OSFI, looking at all these changes, is it for them to ensure resiliency in the financial markets, ensuring that the banks remain compliant, making sure that the banks have these capital requirements. Remember, when a individual gets a loan to buy or a mortgage to buy an investment property, that is a loan that generates income. Those loans for the bank have to remain on their balance sheet, and they need to ensure that they have adequate funds to cover those loans in case of default. Same things with combined loan products. So a lot of this has to do with the bank's requirements. So you might be saying, Anth, well, you know, I just have a mortgage. I have maybe a line of credit. I'm not even considering an investment property. Well, capital is what the banks need to deploy in order to give you the mortgage. And if those mortgages, if the capital that the bank holds is now being set aside for a lot of these other products that are already in the system, or that could be coming in, if you're buying a real estate property, you're getting a line of credit, the capital that's going to be deployed for potentially first-time home buyers is going to be more expensive, right? I mean, just think about banks have to lend out money. They have a margin, they have a spread, they need to make a profit. Could that money get more expensive for day-to-day Canadians, especially if a lot of their capital requirements are going to be reserved for these other products in a deteriorating market, especially considering what actually happens? I mean, talking to a lot of our clients, especially those who have real estate investment properties, there's a big fear. I mean, think about it. As rents decline, maybe individuals lose their jobs. What happens? What's usually the course or the natural course of progression if you own a rental property? This is your small mom and pop. You're working, you have an investment property. That investment property is, collecting rent, but that rent isn't enough to cover the entire mortgage, property taxes, heating, so on and so forth, insurance, yada, yada, yada. Well, you're underwater already. Now imagine for a moment you have multiple properties. You have one or two tenants that vacate the property. You're not able to find someone to replace that or re-rent that property at the same rate, or maybe it's a lot less. So the debt or the coverage that is required is greater. Or maybe you'd face a complication where someone's not paying you. Maybe you end up losing your job. Well, most likely you're going to pay your primary mortgage first and not necessarily those rental properties. So maybe this is what OSFI is alluding to, saying, hey, with all these problems, with the fact that, hey, there are a lot of potential risk ahead here in Canada, we need to be cautious. So this is literally, in a nutshell, what we're thinking. I mean, if this income changes in the new year for individuals qualifying for a mortgage, capital gets more expensive, the banks may pull back on lending guidelines. Not saying that they will or that they are, but at the end of the day, we see all these changes, and as OSFI sets the regulation, the banks have to abide by it or find ways to circumnavigate it. That's literally the question. So what I'm thinking right now too is also talking to some of these smaller investors that these changes, especially when it comes to Canadian investors, in a time where we're trying to make affordable housing better, generally the mom and pop, the smaller investors, the smaller builders, the guys that are not funded by huge REITs or these big funding pools of rental properties, they're the ones that are a little bit more compassionate. Generally, they're the ones that are more engaged, working with their tenants, as opposed to major corporations that are just renting it out and that's it. You don't pay the rent, they go through the legal process, they don't want to work with you. So this could be opening up a door to say, hey, we want to get rid of the small investor, the small person that wants to make themselves a little bit more wealthy or basically move their way up the social ladder, the wealth ladder, and leave it strictly to the corporations, those who have the means that really don't care about how to qualify because they got the capital to put as much as money they need down, or they raise their own capital and change the course of the market, especially here in Ontario. But more importantly, what about all these rules? The government that wants to make housing more affordable, they want more homes built. And this is going to be a segue for potentially corporations, those that find it less challenging to qualify as opposed to those who will find it more challenging when you think about how income and qualification is changing. So I want to hear from you, your thoughts. I mean, ultimately, is OSFI doing the right thing to help reinforce or ensure that the Canadian financial system is more resilient? Or is it just making changes that's going to favor some particular entities in the Canadian economy? Let me know your thoughts, but until next week, thanks again for stopping by. Make sure you're subscribed, and we'll see you all next week.